Hello, welcome back to the continuing lectures in investments. This is Dr. Jeff Hong, and finally, we are at the final, last topic of the efficient diversification. And it's been a very vast and uh, intense chapter, right, with a lot of depth in really exploring uh, the theory and logic and the practice of efficient diversification. We've gone through a lot of, been through a lot of important concepts such as, Sharpe ratio and information ratio, and the importance of optimal risky portfolio consisting of passive portfolio and active portfolio, and how the weight, optimal weight should be between the allocations, and how we achieve that through train or black model. So the final step is now it brought us to the now the risk of long-term investments. Of course, what we have seen all this time, it basically applies to a long-term investment, but generally we've been, all the models are basically based on a single holding period, right? A single holding period can be 1 year, or 3 years, 5 years, or 3 months, 6 months, any length of time, but just assuming that you keep holding that portfolio or that position, simply updating or rebalancing the portfolio that you are holding. What we are going to look into more specifically in this section is how how 1 year or multi-year how risk of the portfolio is affected by multi-year holding periods, or multi-period holding of your portfolio. And the answer by now must be quite obvious. I mean, holding the any asset, any portfolio longer term would also increase the risk. It goes without saying. I mean, we've known long term, from the bonds, we already know there's a maturity risk. Why? A longer term, right, has more chances of the systematic factors changing to affect the present value of the portfolio. I mean, in case of bond, bond portfolio. Yeah, we know that because um, but to put it, especially interest rate fluctuations, right? But to put it into a more uh, mathematical and statistical uh, terms, the reason that we have maturity risk, or the reason that we have more risk in the long term, is because of variance, right? Why? We've seen it before. Uh, the standard deviation grows at square root of time, which means variance grows with the variance of the portfolio grows with uh, time, right? And therefore, the standard deviation grows with the square root of time. And this is something we've already seen, in like risk and return, Um, and of course, risk premium grows at rate of time horizon. Risk premium, of course, the longer you hold, uh, the risk premium, or even the risk, I, I mean the return, expected return, uh, holding period, return, grows, of course, because the longer the holding period, right? But also since the standard deviation or variance, standard deviation grows with the square root of time, variance growing at square root of time. Once again, this is a question of intertemporal. Intertemporal meaning diachronic. Diachronic meaning what? Uh, across time, right? Or dynamic also means change over time, right? Everything changes over time, so that's dynamic. Um, there's time dynamics, and this is a Sharpe ratio of uh, uh, dynamic time. Make sense? In other words, intertemporal. Now, uh, the whole point, the focus is, do we get a better Sharpe ratio time, or how do we maximize, how do we increase our intertemporal uh, or dynamic Sharpe ratio, right? Um, since we know that the Sharpe ratio is basically 1 year Sharpe ratio, that's why it is S1, uh, risk premium over standard deviation, and it grows with the investment horizon, which means it's a linear function of square root of time. Linear function of square root of time. And a 1 year price of risk, something that is similar, but somehow we know we can take square root of, we can take Sharpe ratio squared. A Sharpe ratio squared, this will be if it is Sharpe ratio squared. Oh, right? Yeah. And if it is Sharpe ratio squared, then both will be squared, right? both will be squared, right? But, price of risk is, just risk premium over variance, right? And portfolio returns are serially uncorrelated. We have already seen in the previous topic, risk and return. Portfolio returns are seriously, uncorrelated, meaning, there's no autocorrelation in the time series. If you want that table 5.2, please refer to the previous, because I cannot bring it up. Please refer to the previous topic, previous video. And we've seen that there was a study, remember, there was like 80 years, a study over 80 years, 80-year period, between, U.S., and world stocks, and, U.S. bond, world, bond, and broken down into 3 sub-periods, right? That was, table 5.2. So, but, somehow there is a fallacy, still, fallacy, that has been long held in the asset wealth management industry, such, that holding the assets for long term. I don't know where I remember where I put. I didn't, because it's a fallacy. I didn't put it here, but I have a misconception, fallacy or misconception that the long-term portfolio holding, the investment position for long term will have benefit of, time diversification. So the risk goes up. But, we know that is already a fallacy, because we know standard deviation grows at square root of time. So to, let's say, to debunk, this is a lot of things in math are either about proving or debunking, right? Mathematically. A theorem, debunking a theorem, or, proving a theorem, right? So, well, because we already know time, there's no such thing as, a time diversification, or, long-term holding period doesn't necessarily, dilute the risk. We want to debunk that fallacy, right? So if you want to debunk it, let's see. Consider 3 strategies for 2-year investment. 2 years is already, long term. Anything longer than 1 year is long term, right? There are, let's suppose, 3 strategies: 2 in, 1 in, and half in 2, right? So 2 in is invest everything in the risky portfolio for 2 years. 1 in is invest fully in risk-free asset in year 1, and fully in a risky portfolio in the other. And the other Third strategy is half in two, which is basically about investing half in the risk-free asset and the other half in the risky portfolio in both years. And let's compare their risk premium, variance, Sharpe ratio, and etc. If you do 2 in 1, risk premium will be 2R, right? 1 in the first year, in risk-free asset, in the second year, risky portfolio. So the risk premium will be R, half in 2. So of course, you understand, there's a risk premium on risk-free asset is 0 because it's risk-free asset. So each year you get, half the risk premium. It's 2 years, so you get R. And if we, variance, grows with time. So for 2 years, just 2 times variance. Just 1 year, risk-free in the first year, risky portfolio in the second, so just variance. If you do it, half year for 2 years, look, a half year, the weight of the variance for half year, again, will be a quarter, right? And 2 years, it will be variance over 2, half the variance, right? And the Sharpe ratio, that means, standard deviation will be, just, variant, standard deviation over square root of 2. Now, if you take the Sharpe ratio, this divided by, right, square root of 2 will be S1, and this is called, so therefore, Sharpe ratio S1, square root of 2. This is simply S1. Again, S1 square root of 2. Now, something 2R over, this looks like 2 times now, let me, I thought I could, do, yeah, because the video has to be within 30 minutes. I will have to come back to this. because it looks like a oh, it's, um, there's something, the link between this and this is, missing. So I'm gonna come back to this later. Now, uh, price of risk. Of course, if we call that P1, this will be also, P1, and this will be 2P1. Because if you divide it by, I mean, this becomes, of course, it's reciprocal, right? Uh, and what is missing here is actually, uh, sigma over, you see, this is why. So, let's think about, the benefits or, benefits and cost of these three different strategies. First of all, two-in strategy has 2 times the variance as one-in strategy. Risk is not lower for longer-term investors. Okay, definitely. Half into strategy has only half the variance of one-in, and only quarter of quarter variance of two-in. So when less risk than two-in is desired, right? Uh, so the one that has the highest risk is, of course, two-in, right? When less risk than two-in is desired, spreading risk evenly over time rather than lumping all risk into a concentrated period. In other words, one-in strat, one-in. Uh, uh, Spreading risk evenly over time is the best strategy. The Sharpe ratio of half in two is greater than the Sharpe ratio of one-in by a multiple of square root of 2. So does half into offer meaningful benefit of time diversification? No, even if that is the case, uh, uh, this limited notion of time diversification is faulty. Um, so obviously, okay, so let's compare two-in with half in two. So the let me go back to this table. Better Sharpe ratio, right? So, I mean, you wouldn't consider, because both two-in and half in two have better Sharpe ratio than one-in. We're not even consider one-in, right? We're not going to consider. It's only a competition between now two-in and half in two. Yeah, that's why we compare two-in with half in two. Investor with risk aversion, A, will allocate the Y, which is the weight in, risky portfolio, right? And remember this Y from, from, a previous topic. This weight in risky portfolio is basically the price of risk over. This is also price of risk, but this is the investor's price of risk, and this is the portfolio's market price risk. In other words, that's why I didn't have any other space on the slide 46, so I had to put it here. This is the risky portfolio's price of risk, and A is the investor's price of risk. So for 2N, this weight will be the price of risk of the portfolio over investor. For half and 2, this will be 2 times price of risk, portfolio's price of risk, over A. And that was, right? 2 times price of risk, right? So obviously, half and 2 gets 2 times allocation as 2N, but only half as heavily invested in the risky portfolio, right? 2 times allocation as 2N, but only half as heavily invested in the risky portfolio, because every year it's half. So these effects are canceled out, right? Whether you, that's why, I'm saying it is faulty, the time, because, it doesn't offer any more benefit, right? Any more benefit than, 2-in strategy. Higher risk and return of 2-in are offset by reduced allocation to it. Okay. And that leads to 2-in. Half and 2 does not elicit higher allocation in risky portfolio. With horizon of, now that was 2 years, 2 years in an example, but with T years or N years, with horizon of T years, N over T in time T years puts 1 over T, right, in risky portfolio each year. So price of risk will be now, not 2 times, R over variance, but it's T times R over squared, R over variance for 1 over T in T strategy, right? Versus price of risk for all in. So will investment in risky portfolio go up as time goes up? Actually, the Sharpe ratio isn't necessarily, better than all in. 1 over T strategy doesn't offer you any better Sharpe ratio than all in. So in other words, if you look at the Sharpe ratio in 2 years strategies, same Sharpe ratio, right? So even in T years, it will still be the same thing. Sharpe ratio for both strategies will be 1-year Sharpe ratio times square root of time. And T times fraction of what would be invested with all in T years strategy will be invested each year, which will be equivalent to basically, in both cases. So it's like it's going to be only resulting in choosing between the two is simply sliding or down. Yes. It's just weight allocating, uh, just like on capital allocation line, different with different weights. Choosing between the two strategies is simply sliding up or down the capital allocation line. So despite higher price of risk, overall allocation to risky portfolio is not higher or time diversified portfolio. Okay, so basically, this is just the confirmation of what we already know, right? And then we've been as all these examples, all these portfolios that we've seen so far are basically, didn't make any distinction between like, putting your assets into a risky portfolio and risk-free, and then, in the risky portfolio, the passive and active um, and bond portfolio and all these allocations have been assuming that the portfolio will be held, regardless of, we didn't make distinction between, short term, long term, we just, assume that the portfolio is held for any, length of holding period. But actually, the length of holding period, the question may arise, will there be any difference between, all-in strategy or 1/T strategy, right? Or, like, if there's a, let's not consider third strategy, because that third strategy is this one, which is, which you already, we have found inferior, right? So basically, when that question arises, and in the also even in Wall Street, in asset management, portfolio management, even among portfolio managers, there's some kind of fallacy that, but still held amongst them, that there is a benefit of time diversification. But no, we verified it, and we debunked it. We made it clear that there's no such thing as time diversification, right? And whether you use 1/T strategy or all-in strategy, right? They just the results will be the same. They just end up in the same with the same Sharpe ratio, same same variance, and etc. etc. Okay, so this is the this concludes everything about the efficient diversification. So in our next session, we're going to get started on CAPM and APT. All right. So that's it for this session, this video. I will have to see you in the next video. Okay. Thanks for watching. Stop recording.